Hello and welcome to our YouTube channel. Today we're going to be discussing a topic that has been getting a lot of attention lately: cryptocurrency and US tax policy. But before we dive into that, let's start by defining what we mean by cryptocurrency. Simply put, cryptocurrency is a digital or virtual currency that uses cryptography for secure financial transactions. It's decentralized, meaning that it's not controlled by any government or financial institution. You may have heard of some of the more well-known cryptocurrencies, like Bitcoin or Ethereum. These digital currencies have exploded in popularity in recent years, and many people have made a fortune by investing in them. But with the rise of cryptocurrency has come the question of how these transactions should be taxed. That's where US tax policy comes into play. Now, the Internal Revenue Service, IRS, has been paying attention to cryptocurrency for a while. Back in 2014, they issued their first guidance on how to report cryptocurrency transactions for tax purposes. But as you can imagine, the world of cryptocurrency has evolved a lot since then, and the IRS has had to issue updates to their guidance in subsequent years. So, what does the current state of US tax policy look like when it comes to cryptocurrency? Well, the IRS considers cryptocurrency to be a form of property, rather than a currency. That means that the tax rules that apply to property transactions also apply to cryptocurrency transactions. So, let's say you buy one Bitcoin for $10,000 and sell it a year later for $20,000. You would need to report a capital gain of $10,000 on your tax return, just like you would if you sold a piece of real estate or a stock. On the other hand, if you sell your Bitcoin for less than you bought it for, you would have a capital loss that you could use to offset gains from other investments. But what about when you're using cryptocurrency as a form of payment, like when you receive a salary in Bitcoin from your employer? In that case, the IRS considers it to be taxable income, just like any other form of payment. You would need to report the value of the cryptocurrency you received as income on your tax return. And what about mining cryptocurrency? If you're doing it as a hobby, any cryptocurrency you mine is considered taxable income. But if you're doing it as a business, you can deduct expenses like electricity and computer equipment from your mining income. Now, there are a few special considerations when it comes to US tax policy and cryptocurrency. For example, if you receive a cryptocurrency through a process called a fork or an airdrop, you may need to report it as taxable income. And if you receive cryptocurrency as a gift, you may need to report it as a taxable gift, depending on the value of the gift and your relationship to the person who gave it to you. Finally, if you have cryptocurrency in a retirement account, like a traditional IRA or a 401k, the rules for reporting and taxing those transactions are a bit different. It's a good idea to consult with a tax professional if you have cryptocurrency in a retirement account. Now, as you can see, the world of cryptocurrency and US tax policy can get a little complicated. And it's possible that the IRS will issue further updates to their guidance in the future. So, if you're planning on buying, selling, or using cryptocurrency, it's important to understand the tax implications and to properly report your transactions. A little bit of effort now can save you a lot of headache and potential fines later on. And who knows, with the way cryptocurrency is evolving, it's possible that it could have a bigger impact on the broader US tax system in the future. So, to sum up, here are the key points to remember when it comes to cryptocurrency and US tax policy. Cryptocurrency is considered property by the IRS, so the tax rules that apply to property transactions also apply to cryptocurrency transactions. If you buy cryptocurrency and sell it for a profit, you'll need to report a capital gain on your tax return. If you sell it for a loss, you can use that loss to offset gains from other investments. If you receive cryptocurrency as payment, it's considered taxable income. If you receive it as a gift, it may be considered a taxable gift. If you have cryptocurrency in a retirement account, the rules for reporting and taxing those transactions may be different. We hope you found this information on cryptocurrency and tax policy helpful. If you have any more questions or want to learn more, be sure to check out our other videos and don't forget to subscribe to our channel. Thanks for watching.